Great. Good morning, everyone. Welcome to the New York City Retirement Systems Common Investment Meeting for December 11th, 2017. Please excuse the late start. There were some issues this morning related to events happening in New York City, but now we're here and ready to go. So let's start by convening each of the boards, and let's start with NYSERS. Yes, I'm here, Melanie. Thanks.
Here.
Is the mic on? Could you put the mic on or move it closer, please, Melanie?
Now it's on. Okay, so Borough President Manhattan. Here. Borough President Brooklyn. Borough President Bronx. Borough President Queens. Here. Borough President Staten Island.
Present.
International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
DC 37.
Here.
We have a quorum.
Thank you, Melanie. Let's move next to teachers.
Mr. Adler?
Yes, I'm here. Thank you.
Thomas Brown?
Here.
David Kazansky?
Present.
Deborah Penny?
Here.
Mr. Orlando's here.
I am here.
Thank you. Nice to see you.
You as well.
And Ms. Vickers?
Here.
We have a quorum, sir.
Thank you, Thad. Next, let's move to police.
Representing the PBA,
Joe Alejandro, designee for Patrick Lynch, Mubarak Abdul-Jabbar, John Puglisi.
Merritt Riley from the PBA.
DEA,
Kenny Sparks, designee for Mike Palladino.
SBA,
Gary DeRosa, designee for Ed Mullins.
LBA,
Lou Turco.
and the LBA has the proxy for the CEA.
Correct.
The Mayor's Office,
John Adler representing Mayor Bill de Blasio.
Commissioner of Finance,
Antonio Rodriguez, designee for Finance Commissioner Jack Jiha.
Comptroller,
John Dorsett, designee for Comptroller Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. And who's doing a fire? Let's just say fire. Put your mic on, please, Pat.
Mr. Gerard Fitzgerald for the UFA.
Leroy McGinnis with Gerard Fitzgerald's proxy.
Mr. Edward Brown for the UFA.
Here.
Mr. John Kelly for the UFA.
Eddie Brown for John Kelly.
Mr. Thomas Phelan, Pilots UFA.
Here.
Mr. Jack Kelty, UFOA.
Here.
Mr. John Farina, UFOA.
Here.
Mr. Paul Mannix, UFOA.
Here.
And Commissioner Terrell Brown for the Fire Commissioner.
Here.
We have a quorum.
How about us? We don't count?
Okay, John Adler for the Mayor. Susanna I'm sorry, John. Go ahead.
Yeah, I'm here.
The facilitator's here.
Okay, in the office, the Controller.
Susanna Vickers here.
And Mr. For let's see, Finance. We got Phil here.
Sure.
How's that, John?
Okay, great job. Okay, and for Burrs, Mr. Rich?
Yes. Mr. Adler, good morning. We are represented here today by our chairman, Mr. Raymond Orlando. We do not have a quorum, and we will administer this business at our next board meeting on December 20th. Fashion Industry High School, if anyone's invited.
Is that true? Okay, thank
Very
you.
true. Not everyone's invited.
Right. Okay. All right. Thanks. Great. So everybody's here. I just want to offer a welcome to Commissioner Terrell Brown, who is the new representative for the Fire Commissioner, taking Commissioner White's place. And just welcome to the Common Investment Meeting. I do think that Doug will be here later in the morning, and we'll do recognition of him after he arrives. Okay, so just going over the schedule, we have the quarterly performance report coming up next, and then we will entertain motions to exit public session and enter executive session to hear from managers. And we have 2 managers up here, and then we'll have lunch up here, and then caucuses downstairs. Okay, so that's our agenda for today. So with that, I will turn it over to Mr. Evans to take us on our quarterly performance review.
Thank you very much. We're going to start with Mike Haddad, who will take us through the macro outlook, as is his custom, and then I'll be up with the performance.
Good morning, everyone. Final sim of 2017. Exactly. I'm going to talk about markets performance for the third quarter, and in the usual format, I'm going to start with a quantitative look at the market's returns in the third quarter. Second part will be a narrative to try and explain these very strong returns, and the third part, I want to update the trustees on what I kicked off last quarter with potential regime shift in interest rates. With that, let's kick it off. So here is a look at the returns in public markets, your asset classes for the third quarter. I would draw your attention to the third column, which lists the returns for the various asset classes. And let's start with equities. These are extraordinarily strong returns for the quarter. Now, one quarter does not a year make, but if you were to annualize the third quarter, which is our first fiscal year, we would exceed the very, very strong returns for the fiscal year ending 2017. So just one quick commentary on this. The EFI equities, the second line, and emerging market equities both benefited from currency strengths in those markets. You know, as a reminder, we're all studying the FX hedging policy here, and we do not hedge as of now, so we benefited from about a 2 or 3% decline in the dollar, which helped those foreign currencies versus the dollar. It also points your attention to the returns in fixed income, all positive. It's in contrast to what we saw in the fiscal year that ended, in that government rates were actually unchanged to lower on the quarter. Credit spreads tightened, resulting in positive returns in all these asset classes. And again, as a reminder, the shifting correlations between fixed income and equities. So while last fiscal year we saw a negative correlation, in the first quarter of this year we see a positive correlation. So how do we explain these very strong returns? Let me start first with the equity market. So very strong equity earnings in the third quarter. So just to try and explain this chart a little bit better, I labeled the first column the second quarter 2017. What that is the year-over-year numbers that result from the second quarter as compared to the year-over-year numbers in 2016. Why am I talking about second quarter earnings when we're talking about third quarter? It's because equity companies report their earnings numbers in a quarter lagged. So kind of like private equity, it's all with a 3-month lag. So I draw your attention to two things here. The absolute numbers are very strong, and the momentum is strong too. So increasing earnings on both a quarter-over-quarter, year-over-year basis, and that helps explain a lot of the equity market rally. Fixed income has benefited from a combination of low inflation, stable to unchanged yields, and continued global quantitative easing. So I tried to show in the first couple lines headline inflation for the 3 major regions in the world, and while headline inflation was up in all 3 regions, core inflation was unchanged, if not lower. And I would also point out the absolute level of inflation is still low, still below the 2% target by all the central banks. Long maturity yields were roughly unchanged across all 3 regions. And then the real big driver, and I know I harp on this a lot, but is the global quantitative easing. So you can see the bottom lines is the amount of quantitative easing still going on by the European Central Bank and by the Bank of Japan. Roughly unchanged quarter over quarter, and that's been a very strong tailwind to all financial markets. I've shown some version of this slide a few different times, and I'm not done with it yet. What I would point out on this slide for this part of the presentation is to focus on the blue line. So within the slide, it's called stock. I labeled it in my bullet point aggregate. And what it is the total amount of quantitative easing by G4 central banks. As a reminder, G4 in financial language is the Federal Reserve, the ECB, the Bank of England, central bank, and the Bank of Japan central bank. And that number's gone pre-crisis from almost $6 billion to peaking somewhere just shy of 16 trillion, and that's the scale on the left-hand side. The shaded area is meant to represent market consensus on what global quantitative easing look like going forward. So the takeaway from this slide is global quantitative easing has yet to peak. If you take at face value what's on this graph, it's going to peak sometime in mid-18 before it gradually starts to decline. And as long as this aggregate amount remains in markets, so $10 trillion of buying power in financial markets, it's going to support certainly fixed income, if not all public markets going forward. The orange line we're going to get to in a few minutes, so if you bear with me. So the last positive factor driving financial markets is this laundry list of geopolitical concerns. And while they're meaningful, while some of them are scary, there's been no tipping point yet to cause any kind of impact on either economic growth or financial markets. So just a couple highlights. So China concluded its 19th Party Congress in October. President Xi emerged with unprecedented powers in China. And China's economic leverage and bubble-esque type things are well known in markets, but now with Xi having even more control, it at least appears it's going to be not a point of concern for the time being. And then the Washington, D.C. Trump Republican, I just kind of labeled it all together. So the tax plan negotiations are going on. I have another slide on this later, but this has ended up being a positive for financial markets in the third quarter, as the markets have anticipated something getting done on some kind of tax plan. And then the last line on oil prices. So if you remember the beginning of 2016, markets cratered. Part of that had to do with oil making its low for the entire move. And it impacts a lot of different markets because of the impact of the market cap of energy stocks. But now oil prices are stable to higher. It's been a few quarters in a row now, and it's really on the back of production cuts in conjunction with OPEC and Russia. So before I leave Q3, any questions or comments on anything I've brought up?
It looks like you've stymied us.
Or it's the bacon, the coma from the bacon. So last quarter, I floated the idea of a potential regime shift in interest rates, and I wanted to update the trustees on things that have taken place since I was in front of you 3 months ago. The Fed, I apologize, I had the wrong date. It was September 20th because it was the date of our last SIM. They announced the beginning of balance sheet normalization. And just to get some of the language out there's a lot of different terminology people use. They'll say balance sheet normalization, slowing down reinvestments, quantitative tightening. They all mean the same thing. The Fed is shrinking its balance sheet. They're the only central bank that's actually shrinking its balance sheet, and they announced that on September 20th. It's in effect in the fourth quarter of this year. It's starting with $30 billion in the fourth quarter. It goes up to $60 billion in Q1, $90 billion in Q3, and it runs at that pace for a yet to be announced amount, but market consensus is somewhere between $1 trillion and $2 trillion. So that impetus that was going into the market from the Fed is now coming out of the market. The second big announcement in October was from the European Central Bank, and they announced a significant tapering or reduction in the amount of QE that they're doing. So starting in January, they're going from 60 billion euros a month down to 30 billion euros a month. They've committed to do that for 9 more months, but they have made no commitment on what they're going to do after that time period. So the other thing I wanted to bring up was policy rate increases. So it's not just the Fed raising rates anymore. They did raise rates at the last meeting. They're expected to raise rates on Wednesday, but the Bank of Canada has also raised rates twice since we last spoke, and the Bank of England has also raised rates. So it's more than just the Fed moving away from the policies that were post the financial crisis. Same slide. Promise you I wasn't done with it. Now I want to talk about the orange line here. And this scale is on the right-hand side of this chart, and this is the flow. So this is the year-over-year change in the amount of QE being done. So you can see that line goes down very, very significantly in 2018. And what that is what I just tried to explain. What the Fed is doing is actually reducing their balance sheet, and what the ECB is doing is reducing their balance sheet at a slower level. So the delta in that, for the Fed, it's roughly, this is where I need my talking points, $330 billion, I think, and for the ECB, another $300 billion. So that accounts for well over half of the total amount that's being reduced on a monthly basis. So while we haven't peaked in terms of its aggregate, the amount in 2018 is very different from the amount in 2017. I'm taking a shot at trying to explain this in another way. So what this slide shows, and I would ask you to focus to the black line, which is the total monthly flow of all four central banks. You can see in the top that this monthly flow peaked in 2017 of this year. It's already started to decline, and this is both from what the Fed is doing and a little bit what the Bank of Japan is doing. And then you can see in 2018 it goes down hard, just like I showed you in the previous slide. And what's important here is even though the aggregate amount has yet to peak, the amount they're doing on a monthly basis has peaked. And why do I keep bringing this up? This is ECB and BOJ. It's because there's been major capital flows from fixed income investors in those areas into our markets. And all things being equal, it's held our interest rates lower than they would be otherwise. And until those policies change, it's going to be a positive influence on our fixed income markets as well. And what I really want you to take away from this is this in the process of changing, and changing hard in 2018. So the last update on the potential regime shift in interest rates has to do with U.S. fiscal stimulus. So I'm sure we're all tired about reading about tax reform, whatever the conference is going to end up with. So I try to just take some median estimates of what the House tax bill looks like, what the Senate tax bill looks like in the quantity of stimulus, what the multiplier effect is, and the last column shows GDP. And I apologize for the smallness of that slide. It's not just tax reform and fiscal stimulus, though, in 2018. We also have hurricane relief, and we also have discretionary spending increases coming. And the hurricane relief number is on my graphic is $80 billion, but the White House has already requested additional $44 billion. And I think we all have read about the disastrous situations in Puerto Rico and the U.S. Virgin Islands. So this number is probably going to go up in 2018. The other thing I would say is on the Senate tax bill, you see a much smaller number for 2018. And just as a reminder, that has to do with the timing of when the corporate tax cut would be done. The House has it 2018, the Senate has in 2019. So sum all this together, and it equals about 1.1% increase in GDP for 2018. And this comes at a time when the U.S. economy is growing above trend. We're at or near full employment. And this typically results in higher inflation. At the same time, it's $1 trillion to $1.5 trillion increase in the deficit. That's increased issuance by the Treasury, and it's hard to conclude anything that this fiscal stimulus package and all of its elements is going to result in higher interest rates, both from issuance from the Treasury, both from higher inflation expectations in the back end of the bond market, and the Federal Reserve raising rates at a pace that's faster than what's built into the prices now. So why do I keep harping on interest rates, and why does it matter to our portfolios? I'll start with U.S. interest rates are the benchmark that every financial asset is measured off of. There's different metrics that how they're measured, but it is the key discount rate for all financial markets. And it has without a doubt benefited from the $9 trillion of quantitative easing that I've tried to show you is in a key tipping point in its reversal. At the same time, fiscal policy is coming at a time when we don't need it in terms of the economy, and that's going to add to inflationary expectations as well. At the same time, there's going to be increased issuance because of the amount of the tax plan. So it worries us that we're at a tipping point with interest rates, and how we are allocating within asset classes. This is important to us, as well as the overall asset allocation. Right.
The impact of inflation. has to be also considered in light of the fact that there's very little wage growth. Because for the members that we represent, and large parts of your labor force, as you know, there's very little wage growth. There's still a lot of slack in the economy. So when you say that inflation is going to rise, or a lot of people think it's going to rise, what does that mean? Does that mean going from 1 to 2, 1 to 1.5?
Well, we start with inflation's a lagging indicator. Just by its definition, it lags economic growth. I think we've all gotten comfortable with the idea that growth is above trend. Productivity is abysmal, as you're aware. Year-over-year inflation numbers, by their definition, year-over-year, are lagging even more so. So if you look at 3-month annualized rates of inflation, they're closer to 2%. And I'll grant you wage inflation on the aggregate has been running around, I think, for 16 quarters between 2.5 and 2.8. So stable at that level. The unemployment rate for those with a college degree and higher is under 2%. So when and where that translates into in wage inflation is I don't know, and I'll have to say I have zero confidence that the tax reform bill is companies are going to all of a sudden start paying more money because their tax rate gets cut. So I don't have a good answer for you. The overall unemployment rate's at 4.1. It historically is a very low number. The shorter-term measures of inflation are picking up. And I think it's a risk underpriced by markets. So you layer it all together and throw this fiscal plan at it, and the risk is that inflation premiums rise in markets, not go decline. Any other questions?
I had a question about the chart that you showed us twice. So my question is, this is based on there not being any kind of dislocation in the market, right? And, we've heard, I think, from various consultants that, the stock market is fully priced, let's put it that way. So what do you think happens if, in fact, there is a dislocation and this fully priced market reverts to the mean, as it were? Like, I mean, in other words, like the numbers that you showed for our earnings over the last fiscal year, that I don't think there's an expectation that can continue, right? And if it slumps, what happens to this chart and what happens to interest rate? What happens to the Fed's plan, in your opinion?
I think it would take a meaningful decline in the equity market to slow them off their pace. Go back to why they did quantitative easing, all three forms of it, and Operation Twist. It was in response to the headwinds from the financial crisis. They don't want to have the balance sheet as a permanent tool of monetary policy. It causes many different dislocations. When they were buying mortgages, they could be accused of setting credit spreads within the markets, and it's not the purview of monetary policy. So I think there is a strong desire to get the balance sheet back to a smaller level, and I think it takes a meaningful change in the equity market to take that down. And I'll also say, we've all read in the press that this is the third largest, longest expansion. It's up to 100 months. It's never done this. It's never done that. Expansions don't die of old age. Expansions die of monetary policy or some exogenous event. So my baseline case is interest rates are going to slowly creep their way higher, both the front end and the back end. And that, at first, is a headwind to equity growth, because I do think the earnings momentum is there. Underlying so the U.S. is fully valued. It's rich versus any kind of forward-looking PE. It's not to bubble-esque territory, but we don't want to go there. EFI markets and EM markets are not fully priced, and they did not benefit to the same extent that the U.S. did with quantitative easing. So I would expect those markets to remain reasonably healthier compared to the U.S. And lastly, 90% of OECD countries are growing at or above trend, meaning that the recovery is now broader than it had been previously. It's not just a U.S. recovery. It's much broader. So I think a baseline case is a gradual rise in interest rates. Earnings remain strong, and that's a counterbalance to earnings. So equity markets maybe go sideways while interest rates rise, barring any of those geopolitical concerns bubbling up into being a flashpoint.
Any other questions for Mike? Great. Thanks, Mike.
Okay. Thanks very much, Mike. As usual, very helpful insights. We love getting these insights at the weekly investment committee meeting. Headwinds are coming, is the bottom line. But what we had during the quarter that we're going to cover is a big tailwind. As Mike said, the markets were extremely strong. The riskiness of the markets, the volatility is unbelievably low. If you look at the column on the left, which we usually use to rank the systems based on the volatility or riskiness of the portfolios, they're all extremely low in the 3% range. And when we do the strategic allocation, we're looking for, high singles, low double digit returns. I had the team, the risk management team, double-check these numbers because I just couldn't believe that they were this low, but in fact, they are this low. So we're in extraordinary times in terms of the calmness of the markets, and yet the markets continue on a tear, up, almost 4% in most cases, and Burrs was actually up more than 4%. Whether you're looking at fiscal year-to-date results, one-year trailing results, or three-year trailing results, the numbers are very high. We're beating in all the cases of all 5 systems. We're beating what we would do if we were just indexed, and that's the second to the bottom line, public market equivalent, 65-35. And we're beating the Tux median return for all but one fund in all 3 of these sessions. So, things are good. Solid performance. We'll go through the asset allocation now. When you look at growth, you can see that we're basically on target. If you're in the middle of this line at 0, you're right on our strategic target. We're a little overweight international public equities. As Mike said, we're comfortable with this. The earnings growth is a little behind the U.S. The valuation's a little behind the U.S. and the cycle's a little behind the U.S. So we're okay with a slight overweight, but we do continue to rebalance, keep these in order, and of course our basket clause keeps us focused on that as well. If you go to inflation protection, you can see that we are pretty much in line, although both TIPS and bank loans are a little underweight versus the strategic allocation. This is something that will be cured with regular rebalancing. And if, as you listen to Mike's talk, you can see that these are areas that we would not want to be underweight if we are risking increased inflation. So we are very focused on these areas now. Not all of them can be quickly changed, particularly bank loans, but expect us to do regular rebalancing here. In deflation protection, it's mostly been about getting that Treasury portfolio up to target. We've been working on that for a number of months. You've watched those bubbles on the left, which are, the large part of the deflation portfolio, get up to be at the strategic allocation. They're about there now with most systems, and really now it's a question of the duration or the interest rate sensitivity. This could be my next slide. But I just want to make a point on the middle panel, which is the mortgages. We're underweight mortgages. We're comfortable being a little underweight mortgages. It's not much, as you can see. But given the current tight spreads and the tremendous central bank ownership or involvement with this market, as Mike talked to you about the unwinding process, we're okay being a little underweight mortgages. I wouldn't look for that to move in the immediate future. We're right in line with credit. I'll talk about the performance in a minute. Here is a key slide to look at in terms of our duration. We had to increase the duration in all of our portfolios for the Teachers, police, and fire, we had to increase it about 6 years from when we started. And for NYSERS and BRRS, less than half of that because they're not opting for a high-duration portfolio. We're 50% of the way there at the end of September, and that's what we promised you, that we would get there. It was painful because we have the outlook on interest rates that we do, and we would expect to lose money as interest rates go up on our Treasury portfolio. But the thing to realize is that this is insurance. So you always expect to lose money on insurance. And that's the way to look at this part of the portfolio. But whether we have half insurance or full insurance depends on the market environment. We have a model that we've shared with you that we built with the help of Rokutan. We'll continue to monitor that very, very closely over these coming months as we go about the process of taking the duration up the rest of the way. But we're going to look at market conditions and won't do it automatically, as is our plan. Okay, talking about performance, I would love to be able to show these slides to you each and every quarter. This is a good, smooth, clean quarter for us. Fiscal year to date, portfolio results were up in the 4% range, way ahead of the 7% pace. 7% pace would be about 1.7%, so that we got more than a quarter's worth of return. Outdistanced the benchmarks, and you can see the difference on the right panel. That ranges from 22 to 88 basis points. 100 basis points is a great year in terms of excess performance. So to have 22 to 88 in the first quarter is something we're pleased to be showing you. If we break down that excess return and say how much is coming from asset allocation or being overweight or underweight sectors, I was just going through the overweights and underweights, that shouldn't play a huge role over time unless we're really taking a pronounced positioning in the portfolio, which we would talk a lot with you about. We would expect that to be zero or near zero over time, maybe slightly positive. It was about zero during the quarter. All of the good performance that we had came from manager value added or the managers beating their benchmarks. And so we're very happy about that. We're particularly happy when you look at this quarter versus what we've been doing over a 3-year period. It's been tough for our managers to beat their returns. It's tough in general, and only BRRS has been able to do it over the past 3 years. So we're hoping that this quarter is indicative of a trend. The outperformance did not come from equities in the U.S. That is a very difficult area to add value. As you know, we've reduced the U.S. equity active portion of the portfolio quite considerably over the last 5 years or so. We really only take quantitative mandates in the large and mid-cap area, and we do focus on small cap to try to outdistance the market. But it's tough there as well. Let's just look at small cap. You can see that some systems have done on the right panel quite well. The teachers, notably, over the last 3 years in small cap relative to the benchmark. But everybody built character this quarter. And the reason we built character is that one of our best managers, Brown Capital Management, had a tough quarter. This is an excellent manager that runs a narrow portfolio. I think they have 37 holdings right now. They have a terrific long-term track record. But one of the things in active management in general, if you have good concentrated managers with wonderful long-term track records, it doesn't all come at the same time. And they'll have pockets where they don't do well. And Brown Management had one of those pockets this quarter. I can go through the ins and outs of it, but they're very narrowly focused, a lot on IT and healthcare names, and they were just in the wrong places this quarter, behind by about 170 basis points. International, a much happier story. It's been a happy story for the past 3 years in all systems. We've been outdistancing the benchmark with our active international mandates. Pretty much had the same managers. Held these managers for many, many years. They're terrific managers. They've got long-term processes in place. They had an absolute barn buster quarter this quarter, and I'm going to drill down a little bit so you can see where it's happening. They weren't all positive. We had one that was on the negative side. But Acadian, up on the top, up 180 to 335, depending on the benchmark. We're helped out by being able to make some out-of-benchmark bets in emerging markets. Also helped by good stock selection in Japan and Hong Kong. Bailey Gifford had a huge quarter, took full advantage of the guideline flexibility, and also had good stock selection in autos and semiconductors. There's a new PM in Bailey Gifford, and this is often a good indicator of whether you've got a great partner, great long-term partner. They handled the switch to the new portfolio manager extremely well. Lots of heads up ahead of time. The new portfolio manager has got a biotech background, which we think will be very, very helpful, and so we're very pleased with this, and a new PM can often be an unsettling time. Spruce Grove, which is a value manager, had a different complexion in their portfolio. They were overweight materials, which was good this quarter. Underweight staples, which was also good. They had some good stock picking. And this is another case of retirements being handled well, giving us more confidence in them, not less, as they make generational shifts. Pyramus, which is owned by Fidelity, is in the small cap area. Here we've got a bit of a portfolio benchmark mismatch. They're a small cap value manager. They're compared to a core benchmark. We need to deal with this when we re-up the contract, if we re-up with them. That was a good piece of this. They were hurt by a huge bet that they had in a transportation company. It was a trucking company. That put a hole in the side of the portfolio, and then being a value portfolio in a market that was not kind to small cap value was the rest of it. I wanted to mention one of our emerging manager of managers here. They didn't show up in the hit parade, but they almost did. This is Leading Edge. Very strong start to their new mandate, 150 to 200 basis points, depending on the system. Had multiple sub-managers performing, and so we're very, very pleased to see this. We're always on the lookout for good emerging managers that we can make direct investments in with full contracts, and so it's great to see them coming out of the chute well. But even when an emerging manager or manager is having a great quarter, some of the sub-managers can go out of business, and one of their guys that was a large cap value mandate actually closed up shop during the period of time. So these emerging managers are fragile vehicles. We look at them carefully. We want to make sure they're stable enough before we invest large amounts of money. But Leading Edge really started off with a great time for us. Okay. I see that my notes didn't all print out, so I'll be winging the rest of this. In the high yield level, let me just quickly see. No, it didn't all come out of the printer. Okay, so in the high yield area, we had a decent quarter. We're a little behind the benchmark. I think we were 165 versus a benchmark that was a little better. We're 30 basis points or so short. We had some managers doing well, some managers doing poorly. Generally looking forward to the RFP that's coming up. We'll be talking to you in the early winter about this. We've had some trouble performing in this area. Some of the managers, I think will be returning, and some won't. But this is an area that we should be able to produce excess return, and we've struggled a little bit. Bank loans had a decent quarter. I think it was up about 119, up about 12 basis points versus their benchmark. We also had a mix of managers that were doing well and doing poorly. The key was to avoid retail in bank loans. In general, most of our managers avoided exposure to retail. It's the Amazon effect helping out here. The bottom line here, we're pleased to have a small but positive quarter in a positive environment. Where we really expect the bank loan portfolio to shine is when the chips are down. This is a defensive portfolio, and we expect when the markets are deteriorating that these guys will shine. Also, bank loans help you in an inflationary environment, as I mentioned. So this is an area to watch. Hedge funds were about break even. I wouldn't pay attention to the NYSERS numbers. It's now so small. It's in runoff mode, but police and fire are about break even with the benchmark. Now, remember that the benchmark is the HFRI index plus 100 basis points. So if we're flat, we're outperforming the HFRI by about 100 basis points. The direct portfolio actually outperformed by 120 basis points versus the HFRI index, which is good, very diversified. In general, the tactical trading portfolios that are focused on emerging markets did better than the tactical trading portfolios that are focused on the developed markets. And we've structured the hedge fund portfolio so that some are up, some are down, that they're all based on various factors. But we're pleased to see direct continue to increase. The fund of funds portfolio had another tough quarter. We're down 170 basis points relative to the benchmark. I'll just quickly look at the winners and losers. Again, you see emerging market tactical trading firms like Ferrogaya on the plus side here, and tactical trading firms focused on developed world like Key Squared on the negative, and that was typical across. You have some stock pickers, long short managers that were positive like SRS, and some that had negative results like Altimeter. What we hope is that they have net positive returns over time, and that they don't all move together. So things are good here. I want to stop and just spend a little bit of time on fees in hedge funds. This is a very controversial area, one that there's been a lot of press on. Neil Messing and Mike Haddad philosophy is to find great managers, many of whom are difficult to get into. They're either closed or near closed. They don't want to talk to you. These guys have tremendous pricing power. So in the hedge fund arena, they're the toughest guys to get hedge fund fee breaks from. And yet, Neil and team have been able to get fee breaks. If you look at the base fees, that's the dark blue on the left-hand panel, they've gone from the 160s down to the 140s from 2013 until October of this year. So it's a big decrease in base fees. And then on the other side, the carry has fallen from 20% or so down to 18. So we're not paying 2 and 20. We're paying 1.4 and 18, which is an improvement. And hats off to Neil, who's relentless. He never has a meeting with hedge fund managers where he's not asking for some sort of fee reduction. Okay, we're going to change now to private markets and start with private equity. I think I may change these charts next time so that there's a little bit more information quarter to quarter. If I can remember my notes, I'll give you the details that I was able to scratch out over the weekend. In private equity, things are running actually quite well. Our primary managers are now to the point where they're the great majority of the assets. Alex and his team were speaking to you last quarter and showed you how much better our primary managers were doing than the runoff managers. And you can see this in the overall results. If you take a snapshot of the the dollar-weighted return, cumulative dollar-weighted return here versus a year ago, it's up 55 to 65%, or 55 to 65 basis points during the period of time. And so we're in the 9s and 10s, and so we're inching it up. These are cumulative numbers. It was a very good period of time, and the private equity underwriting continues to march along. Opportunistic fixed income. This was a good quarter to be focused in energy. Energy did extremely well during the quarter. Also, being long duration helped. And our numbers were positive. We were, I think up 165, slightly behind our benchmark index, which is a combination of the high yield and the bank loan index. But this was a quarter that we actually expected our portfolio to do more. They got hit a bit during the energy downturn, and so we would have expected a snapback in this quarter, and we didn't really get one. We came up a little short of the benchmark, so we're a little disappointed in that. There were some air pockets. Lone Star which is one of our big holdings, had a really tough quarter. I think they were down 7% for the quarter. Their cumulative numbers are still terrific. They got hit by 3 big markdowns. One was in a big shipping company. So these are volatile areas. This is a risky asset class. The numbers are positive. We want to get to that solid line, 300 basis points PME spread. We're getting there. And a little disappointed we hadn't made more headway in this quarter when oil stocks were strong. Private real estate core. I think this number was about 150, 100 to 200 basis points on a time-weighted basis. Let's see, it was this quarter to last quarter. This is a tricky area, and my staff came in and got it through my head that we can't only look at the core market on an IRR basis or dollar-weighted basis. And the reason for that is that the core real estate area is made up of typical private partnerships where the manager decides when to put the money to work. There it's completely correct to have the dollar-weighted rate of return. But we also have a large exposure to open-end funds. And with the open-end fund, we make the decision on when to invest the money. And that's the case with most of the public markets, and that's why the standards in the public markets are to look at time-weighted return, which does not look at the timing of the cash flows. Most of the negative IRR here is due to us deciding to thunder into the core real estate market at the top before the global financial crisis. And we've been living with that over time. We are making good progress. If you look at the underwriting and the increase in time-weighted returns versus benchmark, as I mentioned, we're making steady progress. But that is the reason it's us more than the managers. The managers' results are good to very good relative to their benchmarks. Non-core area, completely correct to have it measured relative to time or dollar-weighted rate of return. Numbers are much stronger, and we had another good quarter. Finally, we'll end with infrastructure. Petra Nikolova, who runs this group, says that she wants to have boring companies that she invests in that have fantastic returns. And we did that again this quarter. This is a cumulative number. I've given cautions in the past that the numbers started out very strong because we had a single partnership in pipelines that flipped the pipeline very quickly and made an extraordinary rate of return. But I have to say, after looking at these numbers closely, that we've broadened out the portfolio quite considerably, and the IRR continues to march along. We've increased the IRR by a couple percentage points since last year, and so the infrastructure group continues to go full guns. With that, I'll conclude my remarks and take any questions.
Questions for Scott?
Antonio.
Maybe tell me if this is better for public or executive, but with regard to OFI, was there any difference between either some of our strategic partnerships versus, say, the middle market lending, or is it we're kind of across the board, a little disappointed, or did some of our different structures do better than kind of the closed-end funds that we?
It was a mix, I think. Is Wesley Wesley, come on up to the mic here. He can go through the details, but it was a mix. We did have a couple of strategic partnerships that struggled with energy that we were hoping for a lift, but I think also in the funds as well. But Leonard, go ahead.
Hey, Antonio. Hi, everybody. Good morning.
Good morning.
It was definitely a mix, like Scott said. On the direct lending side, it was definitely more stable, where you had about a 2.5% return, and on the macro funds, the macro funds such as Marathon and Apollo, they saw some volatility. For instance, Oak Hill had above a 2.6% return, whereas Marathon had about I think a 98 BIP return. So that's where the volatility was. But I wouldn't say it was because of the structure, SMA versus commingled fund. Yeah.
Okay.
Other questions for
Any
Scott?
other questions?
I have one question.
Yes. Don't go too far, Wes.
So we finalized our asset allocation in June of 2016, about 18 months ago. And if I'm remembering correctly, we agreed at the time that we were going to review the asset allocation every 18 to 24 months. So is there a plan to do an asset allocation review, not a full board review like we did a year and a half ago, but a review in the next 6 months?
Yeah, I think that's an excellent point, John, and I would not be surprised at all if we're not back in front of you recommending just that in the next sim or two. We're have started talking about it. There's been little or no thought that we shouldn't do another asset allocation for the reasons that you mentioned, and so I think you're quite right that that's on the agenda for 2018.
Great, thank you. Anything else for Scott?
Okay, thanks very much.
Scott. Okay, so I think that concludes our public session business for now. So I would entertain a motion to enter executive session. Let's do it reverse. Let's start at fire. Is there a motion to enter executive session from the fire board?
Motion to move into executive session.
Second.
Great. Motion made, seconded. Any discussion? All in favor of the motion at the fire board, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Next, let's do police.
Motion to move into executive session.
Thank you, Joe. Is there a second?
Second.
Oh, boy, competing seconds. Thank you. Okay, any discussion? All in favor of the motion at police, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries at police. Next, let's do teachers. Is there a motion to enter executive session at teachers?
So moved.
Thank you, Dave. Is there a second?
Second.
Great, second. Thank you. Any discussion? All in favor of the motion to enter executive session at teachers, please say aye. All opposed, please say nay. Any abstentions? Okay, motion carries. And NYSERS, is there a motion to enter executive session?
So moved.
Thank you, Dave. Is there a second?
Second.
Thank you, Larry. Any discussion? All in favor of the motion to enter executive session at NYSERS, please say aye. All opposed, please say nay. Any abstentions? Motion carries. Okay, so we're now in executive session. Can we please turn the cameras off?